If you've ever asked a mortgage professional if you should be going fixed or variable, and you've gotten the long-winded response of tracking bond yields and then projecting the expected trajectory of the current trend, and then it all just ended with, but you still can't predict the market, then congrats. You've just wasted 5 minutes of your life just to boost that person's ego. Look, after 8 years as a mortgage broker, here's how I've distilled down all the knowledge that I've gained about fixed versus variable into an easy to understand way that's useful enough to help you quickly pick the best option for you without overcomplicating the subject. Personally, I like sticking to the stats, and I always fall back to this 2001 research paper that studied the specific question over the last 50 years. The York University professor Milevsky found that if you chose to go variable over fixed at different times during that 50-year period, you'd actually come out ahead 88% of the time with variable. Now think about it this way. If you went to a roulette table and there was a sign that guaranteed that black had an 88% chance to win and red only had a 12% chance to win, which option would you go with? Exactly. Considering the fact that there are so many variables that affect the interest rates, like the news, international tensions, employment rates, inflation, you're pretty much gambling by trying to time the market and hit that 12% chance of actually getting a fixed rate that's going to win over the next 5 years. But also, don't just stick to the stats, because individual circumstances do matter. Aside from the stats, here are the other factors that you should consider when trying to decide between fixed and variable. Your financial situation. Can you handle the rate hikes should rates go up? Your personal risk tolerance. Can you sleep at night if you know that the rates are going up? Your life plans, like moving for work or growing your family and needing a bigger home for that extra space, or just circumstances that could come up like health issues or major renovations. Finally, just personal values, like how much help do you want to provide your kids? Help them with school, help them get a car, help them with wedding costs, help them get their first home, or even if they just want to start a new business, right? You'll need that extra cash in lump sum. The main situation where I actually recommend to go with a fixed rate is for my clients who are first-time home buyers, who are buying at their highest capacity, using all their down payment and saved up money, and don't have a lot of financial flexibility or savings to fall back on should the rates go up suddenly and drastically. Peace of mind, being able to sleep at night, and having a good budget is what should be prioritized at this stage. So you tell me, now that you have this insight, what makes sense to you? Share your thoughts in the comments. If you found that this perspective on the fixed versus variable debate really helped you simplify the decision and make it very easy to pick one over the other, then please share this video with a friend and like and subscribe to get more content like this.